Okay, good afternoon. I'm going to let the music continue playing for a little while until we get ready to get started as people trickle in. So sit back and enjoy some music while we wait for most of our participants to join us, and we will get started shortly. Session today. Let me turn the music off so we can get ourselves started here. So, welcome to today's session, Investor Psychology, how our brain impacts investing decisions. Our topic today is going to be focused on understanding how behavioral biases impact us and how we can use that understanding to make smarter financial and other decisions as well. So welcome back to school. This is our first session, back to school session of 2026. So happy New Year and welcome. Hopefully everybody can hear and see me. If anybody has any difficulties or technical problems, feel free to raise your hand, unmute yourself, let me know so that this can be a productive and informative session. For those of you that have not ventured into this area, I think you will find that it's a fascinating set of concepts and topics that we're going to discuss today. And it has implications beyond just our investing decisions, but certainly it does have a lot of these concepts will have a direct effect on our investing process and how we think about making financial decisions. So it's not unusual for you once you become aware of some of these concepts to start thinking about them and how they might apply to other aspects of your life. But as we say, knowledge is power. So let's get started learning about some of these important topics. So the first stop on our journey is just to know where we're going. So this is our agenda for today. We're going to talk about why psychology matters, how our brain processes money decisions. We're going to review a laundry list of common behavioral biases. I will share with you a few real world examples about how these biases impact real world investors. We're going to talk about some strategies to overcome them, and then talk about some key takeaways and leave some time for questions at the end. Okay, so hopefully everybody's on board with that. And like I said, if you do have any questions or need me to clarify anything along the way, feel free to stop me and inquire, ask the question. I want to make sure that this is interactive as possible. Okay, so here we go. Introduction. So investing is not just about the numbers, it's also about behavior. So we invest for a reason. Oftentimes it is to accumulate wealth, to plan for or accomplish some goal or objective that might be retirement, or sending your kids to college, or buying a house or a car, or taking that dream vacation, or whatever it might be, right? Investing is about something that we do in our lives, right? Money is merely the vehicle for how we go about doing things over the course of our life. So the reason that this topic matters is because many studies have shown that investor behavior often impacts the returns, or I should say, the amount of money that you make, more than market performance. It is about what you do and how you do it, rather than how successful a particular investment might be. So our objective today is to learn about how our brains, this thing here, influences our decisions and how to try to avoid costly mistakes. Nobody's perfect, and we are all, I don't want to say victims, we are all equally, there's an equal opportunity for us to be susceptible to some of these things. So again, knowledge is power, and the more we are able to kind of identify, I might be exhibiting one of these characteristics or these behaviors, the more you can try to take measures to respond to that. Okay, not put yourself in a precarious situation. Okay, so the brain and money. Most people are, or not most, a lot of people are familiar with the idea about the left brain and the right brain. Okay, so our brains have functionally two decision-making systems. Okay, and oftentimes people talk about, your left brain or right brain, and that's because the sides of our brains are associated with these different types of functions. So system one is the emotional system, right? So that is the system that responds fast and automatic and instinctive. Oftentimes, this side of the brain, or this function in your brain, is driven by fear and greed. And it's great for survival, but oftentimes it is risky for investing. And so oftentimes when you hear people talk about investing on a hunch or because their gut tells them this is the emotional side of their brain talking. Okay. System two is the logical part of our brain, right? This is the part of our brain that is slow and deliberate and analytical, okay? It wants to put the puzzle pieces together. This is the part of our brain that handles complex decisions, okay? The one, this is the part of the brain that likes financial planning, again, putting all those pieces together, having a system or logic or rational reasoning for why something might be. Okay, so this side requires more effort and discipline as we use it. So again, our left brain, that's the logical side, logical, detail oriented. This is where we do our analyzing and analytics. Our language function is on that side. The right brain is our creative side. It's artistic, it's intuitive, it's imaginative. So both of these things work together. It's not an absolute or one or the other for most people, but most people do have one side that leans a little bit more dominant than the other. And you can oftentimes tell who tends to be left brain versus right brain. Okay, so keep that in mind. The brain has different functions, and as we go through some of these biases, you can start to think about where those biases might, what part of the brain the biases might be impacting. And so why does investing trigger emotions? Or why would we be approaching investing and money decisions from one way or the other? Well, the reason is that money we associate money with security and survival. And that activates the emotional aspect of the brain. So being able to pay for food and pay for electricity or pay for housing or clothing, things that we associate with kind of basics of survival. So there's an association between money and those things. So that triggers emotional thinking when we feel like we're threatened or there's scarcity. Okay, and when we have market volatility, ironically, like we saw just yesterday in the stock market, it feels like it's danger. Okay, and that has a tendency to trigger this fight or flight response. Right? It's the reaction, the emotional response. Oftentimes we don't sit down, or our first response is to cut and run, get away from the danger, cut our losses and be safe. And that may or may not necessarily be the right decision for your long-term wealth. This concept that short-term pain often outweighs long-term gains, and we're going to talk about this a little bit more, but there's been a lot of studies that show that people have a tendency to weight pain or loss more than they value gains. So we'll talk about that a little bit later, but this is a little interesting graphic that shows, so it's kind of the market cycle. And if you succumb to the waves of this cycle, you have greed and buying at the top, and then fear and selling at the bottom. And then if you repeat that, you're going to eventually go broke. Okay, so let's not do that. Okay. So one of the key insights to this, you probably have already taken it away, but our brain evolved for survival, not for managing investments. And so recognizing when we might be becoming victims of this thinking helps us to make those better decisions. All right, this is the list of some common behavioral biases that we are going to review in detail, each one of them. Behavioral biases are systematic, unconscious errors in thinking, often driven by emotions or mental shortcuts, which if you hear that term heuristics, that is the term for some of these biases. So those are, emotions or mental shortcuts, and that causes people to deviate from rational thinking and frequently leads to suboptimal financial or life choices for that matter. Okay. So on this list, we have the heuristics of loss aversion, overconfidence, herd mentality, recency bias, confirmation bias, the gambler's fallacy, the availability cascade, the framing effect, the Dunning-Kruger effect, the anchoring effect, and the status quo bias. So we're going to go through each one of these. And as we're going through them, I want you to start thinking about how or when this particular bias may have applied to you in the past, right? With regards to some decision that you might have made or some circumstance that you found yourself in. Kind of start thinking about, oh yeah, that might have I might have been demonstrating or being demonstrating or showing that particular bias in that time of my life. Okay, so I had mentioned this earlier, but again, loss aversion. So most people, they move away from pain or loss, right? We try to avoid losing what we have. Okay, so like I said, losses feel about twice as painful as gains feel good. So I don't want to relate this to gambling or otherwise, but you can kind of think about, if somebody were to give you $100, right? And you'd feel grateful and say thankful about it. That feels good, right? All right. Somebody gave you some money, gave you this thing that is useful to you, and it was a nice thing to do, or maybe it was a gift or something else, right? But if you're walking down the street and you dropped that $100 bill as you were walking, you're going to turn around and you're going to start scrambling to, like, where did I lose it? Where did I lose it? And you're going to spend a lot more of your mental energy trying to find that thing that you lost than as when you gained it. Okay, so keep that in mind, that when you feel that loss, the emotional aspect of it is roughly twice what it is when you get gains. So as you're looking at your investments and your investment is going up, it feels good. I'm glad that the market's performing. But when we see the market drop, that's where we feel it in the gut, and it starts to really impact us. So think about that. All right. So the impact of that is investors avoid selling losers, right? Or they panic sell during downturns, right? So selling during market dips instead of staying invested is an example of that loss aversion. I'm just going to cut my losses and I'll be okay, right? Rather than waiting it out for that rebound to come around. And we're kind of seeing the example of that play out today, or at least the last time when I last looked at the market earlier. All right, the next one is overconfidence. Okay. Have you ever had that situation where somebody asks you if you consider yourself average at something, or above average or below average? The irony of that question is that something like these psychological tests show that like something like 70 or 80% of people identify themselves as being over average rather than just average. But when you look at the numbers, somebody has to, the bell curve has to work out, and there has to be some people, quite a number of folks that actually fall in the average category. So this overconfidence thing is we have this natural inclination to believe that our skills and ability are greater than the average or the below average. So that leads to people believing that they can predict markets or that they can pick winners in the stock market. And I will say, oftentimes you can, as an individual, pick a winner, okay? And oftentimes you can pick it frequently. But the trick to investing is doing that consistently over and over and over again. And the numbers show that that is exceedingly difficult to do. So what does overconfidence lead to? It leads to oftentimes excessive trading, concentrated bets, or ignoring diversification. So knowing that this particular stock, this is going to be the winner for the long run, and I'm just going to ride it all the way into the sunset. Or when we're causing that excessive trading, well, every time you make a trade, that comes with usually comes with transaction costs, trading fees, and other things. And so when you have those costs, that drags down the overall return that you would get on an investment. Or concentrated bets, putting all of your chips into just a few key stocks or other types of investments. So those are the types of things that demonstrate overconfidence. Okay, so it is natural for us to believe that we are stronger than we otherwise might be. Has anybody ever heard about the lemmings running off the cliff? Right? So this is the herd or bandwagon mentality. This is you going out with your golf buddies, and all of a sudden your golf buddies are all buying the same thing. So you decide, I'm going to follow their lead. Okay, so it's following the herd or bandwagon mentality is following the crowd instead of sticking to a plan, because there is the FOMO, fear of missing out, FOMO. We have this desire to feel like if somebody else is making this decision, well, they are right, so I should follow them, rather than sticking with the plan that you have set up. And so what happens here is this leads to buying at market highs and selling it at market lows. So as the market's going up, you get this fear of missing out syndrome happening, and all of a sudden everybody's running off of the cliff. So some examples of that are the dot-com bubble or the meme stock craze. If you recall the GameStop craze that was going on, and they happen so frequently. So, but hopefully everybody's had some degree of an experience with that. And so we got this little cartoon says, I don't know where we're going, but from the look of this crowd, it's got to be good. And you can see where the little lemmings are taking themselves off the cliff. So the irony about that little cartoon is that apparently lemmings really don't do that very often, but they've somehow attracted the theory that they do. Okay, recency bias. Okay, what is recency bias? So recency bias is the tendency to overweight recent events when making decisions. Okay, so we put more weight on something that we might have seen in the news or something that has happened within the last week or two, rather than looking at similar historical events that might have been further out in history. So that has the effect of causing us to assume that recent trends may continue forever when there's this term about reverting to the mean, right? So when you have a data set over time a mean. The mean is the average, right? So your data is going to revert to whatever that average is. And so when we have this situation where it's been going up, been going up, we have this inclination to assume that it's just going to continue going up because that's what it did. Yeah, that's what it did yesterday. When in fact that's not necessarily the case. So this example of the markets went up last year, so they'll keep going up. And this little cartoon in the bottom says, your evaluation is based on your next 30 seconds. Go. And so the guy here has got his eyes wide open. Like, well, you're not counting everything that I did for the last year to make you money. And you're just going to base my assessment on the last 30 seconds. Well, that's not fair. So, all right. So moving on, confirmation bias. This is one that probably applies beyond the markets, but definitely applies to our decision-making process when we are talking about investments. And so what is a confirmation bias? We as humans have this inclination to want to seek information that supports what we already believe. So rather than looking for the neutral, just give me the facts, ma'am, type of a circumstance, we're looking for information, and we seek information that supports things that we already believe, and that may be to our detriment. So that may cause us to ignore contradictory evidence, things that show or prove how we might be wrong, or it also might reinforce poor decisions. So, if you buy a bad car, well, that might cause you to rethink whether or not that car is good or not. When maybe they made improvements into that vehicle, and it's no longer an issue. So. So an example here is only reading bullish articles when you already own the stock. So reading articles or information that bolsters the idea about investing into a specific area. And so the little cartoon in the bottom says, I've heard rhetoric from both sides. Time to do my own research on the real truth. And the middle shows literally the first link that agrees with what you already believe, and jackpot. So this person is clearly suffering from a confirmation bias rather than looking for some objective information. Okay. The gambler's fallacy. All right. Hopefully nobody are serious gamblers or have gambling problems. And I don't want to relate investing to gambling. I know I have the conversation frequently that people feel like investing is just gambling, and there's lots of differences, but we'll just talk about the gambler's fallacy and how that might apply to our investing decisions. So the gambler's fallacy is a mental phenomenon where we believe that past events influence the outcomes of random situations. So, you're playing on the craps table, and you blow, and you hit the 7, and so now you know that the dice are hot, so you just can't lose. And so here we go. We're gonna go for the knockout. It's as long as the dice are fair, it's a random act, right? So the previous roll has no influence on your future rolls. The same thing holds true for our daily investing decisions, right? Yes, there are circumstances that do impact the markets, but what happened yesterday in the markets does not influence what is going to happen today or tomorrow. The things that happen around us, politics, business decisions, those types of things, those do impact what happens in the markets in the future, right? But just what happened, whether the market was up or down, does not have any impact on whether the market is going to be up today or up or down today or up or down tomorrow. So just keep that in mind. That is, they are independent data points. And so this idea about thinking the market is due for a rebound after a losing streak, that may or may not be true, right? Now we can look at trends, and I don't want to say data is ignorant, right? There is some elements of truth in data, and again, getting back to the reverting to the mean, but that does not it's not necessarily an A or B situation. Okay, so this example of assuming a stock will rise because it's fallen for weeks, we all know different circumstances, different stocks that were bound to drop, or they were bound for a bull market that never materialized. So. All right, so keep that in mind, gambler's fallacy. The availability cascade. Okay, so we have confirmation bias, okay, and recency bias. All right, so recency is things that are closer in time to us. Confirmation, things that we're looking for confirmation for things that we already believe. The availability cascade is where if you have repeated exposure to something, it makes the idea seem more likely or true. Okay, so if you're just getting pounded with information, you have this tendency to think that it may be more true just because you have more exposure to it. And that may or may not necessarily be true. Okay, so what happens here, you have the overestimation of risks or opportunities based upon media coverage or the frequency of information. So an example here would be panic buying of gold after repeated news stories about inflation. And ironically, we have seen gold at record prices recently, and the overall inflation levels, although not back to where they were over the last decade, they've definitely come down from the highs that we saw a few years ago. So the availability cascade, the more information you're exposed to information, the more likely it seems to be true. Okay. All right, the framing effect. All right, has anybody ever had somebody ask you if you're a glass half full or half empty type of a person? So that is effectively the framing effect. So your decisions change based upon how the information is presented to you, okay, how it is framed. So the impact is choosing a quote 90% success rate over a 10% failure rate, even though they're exactly identical. They have the same probability, but if somebody presents you with a 90% success rate, you might be more inclined to have an optimistic opinion about that, rather than if somebody frames it as a potential 10% failure rate. So keep in mind how things are framed to you, and take the time to inverse it or look at it at the other perspective. How is this particular question or situation framed to me, and am I looking at it correctly? Okay, so the example here is responding differently to a market correction versus a crash. So back in April, when we had kind of the tariff tantrums, that really would not be characterized as a crash. It was really more of a correction, but the people didn't feel it at the time because of how it was being framed. Okay, or if you were more supportive of those things, those decisions, maybe it was framed as a correction. You're okay with it, right? So again, how it's framed is important. Okay. The Dunning-Kruger effect. This is there's a lot of research that was done in this by these two researchers, Dunning-Kruger. And what it is, it's basically overestimating knowledge or skill in a complex area. Okay. So we have this tendency to make risky decisions without fully understanding all of the aspects of the thing that we're making the decision about. Okay. And so what happens is you have this effect of you start off, the little icon chart here shows you kind of start out at the peak of stupid. You kind of make you have high confidence, but you don't know anything. And then after a few mistakes, you drop down into this valley of despair where you have a little bit more knowledge, but your confidence is really low. And then over time, as you gain more competence and knowledge, you are kind of gradually crawling out, into this slope of enlightenment. So you're gaining more confidence, but also have a lot more knowledge. And then finally, in the flat plateau of sustainability, you're a guru and you have high confidence. Okay. So as you are making decisions, try to identify where in this chart you might be falling. Okay, so the example here is, a novice investor thinking that they can beat professional traders. So just because I have a Robinhood account does not make me a professional trader, right? And so, what types of experience or knowledge or skills would you need to have in order to make you a professional in a specific area rather than just a novice? Okay, because anybody can put a chip on red, but that doesn't make me a professional gambler. Okay, all right, the anchoring effect. This is really important when you're buying and selling. So think about when you're buying a car or a house or something, right? So the anchoring effect is where we rely too heavily on the first piece of information, i.e. the anchor, when making decisions, okay? And I will say when you're in a negotiation, or when you're starting a negotiation, this is where the first person to throw out a price, that's the anchor. So if you're trying to sell something, you want to throw out a high anchor, and if you're a buyer, you want to throw out a low anchor. All right. So investors fixate on a stock's past high price or initial valuation. All right. So we establish the starting point based upon the anchor points that we had in the past, not necessarily what its actual true value might be. Okay. So, for example, this stock was $100 before, so that means if it's priced at 80 right now, it's cheap. Well, that probably ignores the fundamentals of why it's $80 now. Maybe they had a bad quarter of earnings. Maybe they had, some sort of negative report or otherwise, right? So, so this concept of anchoring is based upon looking at what data point was originally set that's anchoring me to that particular data point. All right, so that's the anchoring effect. All right, the next one, this is the last one actually in our list, and that is the status quo bias. So what is the status quo bias? This is, we just want things to stay the same. No matter whether or not there's a better mousetrap out there, we are just going to stick with our same old mousetrap, right? It's preferring things to stay the same rather than making changes towards something that might be better. So the impact here might be avoiding portfolio rebalancing or sticking with outdated strategies when just because that's what we know. That's the way we did it before, and that's the way we do it now. So example here might be keeping too much in cash because it feels safe. And so this little illustration on the bottom kind of demonstrates it. So you got the person on the left offering, would you like a shovel? And the person on the right says, but I'm already using this spoon to dig the hole, right? So if they're using a small tool when they could have access to a bigger tool to do the job much quicker, but they're used to it, so they're just going to keep using the spoon that they're used to. So, and I do this all the time because change is hard. So just realize when you might be subjecting yourself to a status quo bias. All right, so a couple of examples of how these biases might have impacted us in the past. So first one is loss aversion. So the example being the 2008 financial crisis. So what happened here? So during the 2008 market crash, many investors saw their portfolios drop sharply. And instead of staying invested, they sold at the bottom to quote unquote stop the bleeding. And this applies to the COVID crash, applies to a number of other market dips as we will. And so, but the biases that affected here. So we've got loss aversion that made the pain of losing money feel unbearable. And so even though history shows that markets recover, people have this thought process, no, this time is different. It's never going to change. I'm never going to make it back. And so they make unfortunately short-sighted, painful decisions. So the impact is that those that sold out, they missed the subsequent rebound in 2009 through 2010, and they locked in their losses instead of recovering. So again, this lesson is avoid making decisions based upon short-term pain and stick to the long-term plan. Okay? And we'll talk about a few strategies of how we manage through these things. The next example is herd mentality. So you had the dot-com bubble of 1999 to 2000. And so what happened? So investors piled into tech stocks because, quote unquote, everyone was doing it. And they were buying and valuing these companies at, just astronomical multiples. These companies that had little or no revenue, all of a sudden were valued in the billions of dollars range. and it's just because everybody else was doing it, so I needed to jump into the pool as well. And so herd mentality drove people to follow the crowd rather than analyze the fundamentals that says, this is not a business, this is just a fad. And people lost money. And so when the bubble burst, many lost significant wealth because they bought at inflated prices. And I will say there's some similarity in the conversations that we're having today around AI related stocks and such. And I don't know what the future holds. I can say there are some differences. Are we in a bubble? I don't know. A lot of these companies have pretty significant revenues. Whether they justify the valuations that they're at now, time will tell. But are we seeing some examples of herd mentality happening related to AI stocks right now? It's possible, right? So again, the lesson is popular trends aren't always smart investments. Do your own research or talk to somebody that can assist you in doing that research. Okay. All right. So we've kind of talked about how biases impact your portfolio, but oftentimes, again, emotional decisions translate to lower returns in the effects of buying high and selling low, right? Investors are chasing rising markets or selling during a panic. Leads to poor diversification through overconfidence or status quo quo bias, or trying to time the market, and thinking that using the gambler's fallacy or recency bias that causes attempts to quote unquote time the market when it just doesn't work. And so the data speaks. So the Dalbar study shows that the average investor, so that's the average retail investor, underperforms the market by 3 to 4% annually due to behavior. So due to some of these biases, the effects here, you are losing 3 to 4% because of our humanness, our emotional aspects that lets some of these biases take hold of us and causes us to make less than ideal decisions. And so, over a 20-year investment horizon, that gap can mean hundreds of thousands of dollars lost in returns that you would otherwise have reaped had you not been a victim of your own brain. So as an example, right, so we've got overall stock market returns of maybe an average over 10 years of 8.5%. I think if we look at the last 10 years, we're probably closer to 9 or 10. And then the average investor return is probably going to be 4 to 5, maybe 6%, leaving that 3 to 4% on the table. And so these things matter. They have a real world impact on your net worth. So what can you do to overcome these biases? Well, first thing is you're here listening or watching this, or hopefully some folks watch this on replay. You're becoming knowledgeable about them. Okay, so that's the first step. Knowledge is power. You're becoming knowledgeable. But the second is to create a plan. All right, hopefully that's a written plan that lays out what your roadmap is and how you're going to respond to some of these things when they occur. I will say automating your investments by doing dollar cost averaging both into your investments as well as out. Okay, so if you're in the accumulation phase, having your investments come automatically out of your paycheck or out of your bank account into that investment account, so you're not even thinking about it, you just know that it's happening, and you can be confident that you're not letting yourself succumb to some of these emotional decision making. Same thing when you're taking money out. If you take the money out in a regular, systematic fashion, it lessens the effect of you being susceptible to some of these things over time. That also diversifying and rebalancing regularly, so you're avoiding any concentration risk and maintaining that discipline. Working with an advisor like myself or anyone else that can act as that unbiased third party and accountability partner to help you navigate these things when the brain does kick in and says, I got to run for the hills, when logic would suggest otherwise. And then mindfulness, pause before reacting, okay? Let that left brain do a little bit of the work when you're making these decisions, right? Take a day before you make the decision, okay? So it's like don't buy the car on the same time that you go to the lot. Go find what you want. We'll find out what the price is, and then go back and think about, is this the right decision? So, as I mentioned, awareness is the key step. Discipline beats emotion, and partnering with a professional does help to avoid some of these mistakes. Some resources, okay? A really fascinating book. These are all fascinating books around how the brain works. So, Thinking Fast and Slow by Daniel Kahneman. Misbehaving, which is the Making of Behavioral Economics by Richard Thaler. And The Psychology of Money by Morgan Housel. Those are all great books in this area. some websites, the Morningstar Behavioral Finance Center or the CFA Institute for Behavioral Finance. And if you want to take a risk tolerance survey to see how you might respond in different market circumstances, then ask us and we can have you take a risk tolerance quiz. It's really interesting, especially when people perceive themselves one way, but the results come back a different way. So, all right, so that is the end of the formal presentation. Now I will open it up to any questions that anybody has regarding any of these topics. So, if anybody have any questions, feel free to unmute yourself and let me know. Throw them at me. All right. And if we don't have any questions, that is perfectly fine. You're always welcome to reach out to me individually if you've got some questions you want to talk about specifically around this. So with that, here's what's coming up next. Our next monthly market update is in a couple of weeks. So Wednesday, February 4th, 2026 at 11 a.m. I will review the current market conditions. I think there's going to be some interesting things to talk about for January. So that keep an eye out for the invitation for that. And our next educational session is going to be on Wednesday, February 25th at noon. So same back time, same back channel. And I'm going to be talking about what am I investing in using data to evaluate investments. So today we're talking about psychology and the psychological aspects of investing. I'm going to flip the table a little bit. I'm going to talk about data, statistics, and looking at an investment from the quantitative side, talking about metrics and those types of things. So if you're more of the nerd, not so much the touchy-feely, that might be an interesting session for you to join me for as well. So, all right, so at the end of February 25th, look for the invitation for that as well. And with that, that is all I have for you today. Hopefully you enjoyed this and you learned something. Appreciate everybody's time today. If you think somebody might benefit from this session, feel free to forward it to them. They will be posted to our website so you can go back and look at it and watch it at any time or send it to a friend. And of course, if you think that somebody might benefit from working with us, happy to have any conversations to assist folks in whatever they need from a financial planning standpoint. So, all right, well, I will let you have the rest of your afternoon. Thank you again, everybody, for your time today. And I look forward to talking with you in a month. Take care.